All right, let's go ahead and start. It looks like we're gonna be live streaming on YouTube today. So that's a new feature.
I like it.
Okay.
All right, go
No
ahead.
pressure. No pressure.
We're gonna be live streaming on YouTube. All right, starting in five, four, three, two, one.
No pressure. No pressure.
All right, starting in
Hello,
five,
everybody.
four, three, two.
I hear some background
Good.
noise.
Echo? Yeah, me too.
Hello? Okay, that's better. Hello, everybody. Wade Comeaux and Jeff Johnson with Catalyst Funding. Very excited to cover the real estate market update with you today. Unfortunately, our guest was unable to make it, but Jeff and I are going to hold down the fort. And I think we have the blessing of some excellent info. So even if we are not as exciting as one of our guests might have been, I think we have excellent info. We're going to keep you guys very informed and riveted through this presentation. So, um, as a reminder, Jeff is the director of lending with Catalyst. Been with us since the day we opened. Very experienced and provides a lot of information on this webinar every month whenever we do it. I'm Wade Comeaux, the founder of Catalyst, and we're both passionate about helping you all succeed in real estate investing. So let's go to the next slide there. Um, a disclaimer: this is general information only. You should not look at any information we provide as direct or any type of investment advice. By attending this event, you acknowledge that Catalyst is not responsible for any loss or damage that you might suffer from information presented in this presentation. Next slide. I do want to go a little slower over this today because I think uh, there have been a lot of new people attending, and we're actually on YouTube Live today. So I want to make sure and cover who Catalyst is and what we do. So we are passionate about being a one-stop shop for hard money and permanent financing loans. So that means one loan officer, one credit pull. You have the ability to get approved for any type of product you would need in the single family 1 to 4 space. We're really experts in that space, whether it be hard money lending, conventional loans, DSCR loans, or anything in between in that single family 1 to 4 space. We're real estate lenders built by real estate investors. So we are passionate about passing on the knowledge and the expertise that we have built over the years from our own personal investing, not only the company, but many people on the team, and bringing that to you to help you succeed. We've been involved in thousands of transactions over the years, and we also have a 5-star average customer experience. We've been receiving a ton of positive reviews recently. Really, the people seem to be really happy. I think, Jeff, correct me if I'm wrong, we may be averaging, I don't know, 7, 8 uh, 5-star reviews a month, something like that. The momentum has been very strong.
A little more. I mean, lately a little more than that. It's probably
Yeah, yeah,
double digits every.
yeah. That's great.
Yep.
Um,
Yep.
and a couple other things we do. If you're looking to fuel your real estate investment goals, we can offer cash outs on your primary property. We can offer cash outs on any of your investment properties. A lot of people are doing that right now. Even though interest rates may be higher, they see the value. We're going to cover a lot of this. There are a lot of very savvy investors that are very aggressive in the market right now. It is a buyer's market, and people are getting great deals. We're seeing a lot of no money out of pocket deals or very low out of pocket deals right now. Of course, if it's a little bit better neighborhood, you're not going to be zero out of pocket if it's in a major metro, but still very attractive deals to where they were a while back. And then we have DSCR products with FICOs as low as 660. We actually have a product that goes as low as 620. It's a little more rigid in some other categories, but we really push that 660 product because it's very flexible. And then we have excellent appraisal products, like one of a kind products, as I'm aware. I don't think anyone else can do the things we do. And basically, we're able to greatly reduce the risk of lower appraisals. So if you're a fixed to rent investor and you want to make sure that you minimize your cash out of pocket, this bridge appraisal product we have is outstanding for that. And then the last thing I'll mention is that if you're having a tough time finding deals, you definitely want to make contact with us on our team because we are blasting out excellent opportunities. I think we sold 2 earlier this week that were just excellent deals, sold very quickly, fixed to rent type deals. And then also we do a deal night every month in both Houston and Dallas with excellent partners, Total Wealth Academy and the Seago Group, and we're selling excellent deals there too. So if you want to get properties, and you also want to have financing on those properties, we think we're a great group to partner with. Jeff, anything to add there?
Yeah, sorry, I kind of froze there. So if I repeat, Wade, I apologize.
No worries.
But I just wanted to hit on two things. One, if you are already investing and you have rental properties, I think Wade mentioned it earlier, but we're seeing a lot of people do refi cash outs on DSCR loans. So you don't have to qualify with your income. We're not going to ask for tax returns or anything like that. It's just simply the property. Um, so that's one way to pull cash out, right? Because a lot of deals, and we're going to go through the numbers here in a little bit, but the market is pretty ripe for investors to kind of strike. So you want to have as much capital as you can get your hands on if you're really wanting to grow your portfolio. Two, if you're not in the game, and Wade might have mentioned this, but if you're not in the game, get pre-approved like now, because like Wade mentioned at deal night, we probably, I think, they present probably in a 2-night span, we're probably talking about 10 to 15 properties. These are all investment deals. They're very strong, but I mean, you cannot buy them unless you're already pre-approved. So that in itself is a good reason to do it. But if you're out there looking on your own and you want to get into it, if you're not pre-approved, most wholesalers will not take your offer because they have other buyers that are pre-approved. So I can't impress it upon enough. Get pre-approved, and then which obviously we can do. Go to our website, apply, but you can pick up a lot of properties because now is a pretty good time to be adding some rentals to your portfolio.
Absolutely. Well, let's dive into Houston. We're going to cover Houston first, right, Jeff?
Yep. So apologize if I look like a ghost here as I open up my screen. It reflects on me here, but so in Houston, there were 85. I can't read the screen. I'm sorry. Is the stats up? Yeah, there we go. Okay. So in Houston, we had 8,500, almost 8,600 sales, which is an 11% increase over last year, and it is a 6% increase over pre-COVID. I look at the active listings. There's 38,000 active listings as opposed to 30,000 last year. The average prices have gone up. So average price got up quite a bit, 4%. It's up to 450. And if you compare that to pre-COVID 2019, a property you bought in June of 2019 would have increased on the average 40% over the last 6 years. Median sales are 346, which is flat. Months of inventory 5.4, which is a little higher than it was last year. Pending sales 8,500, and the days on market 49 days on market. So it's 3 more than it was last year, but it's the same as it was 6 years ago. And I don't think anybody thought anything was like unique or spectacular, good or bad, about 2019. So my take on this, and Wade, obviously you can opine here in a sec, but my take on this is that prices have not dropped. There are still a lot of buyers that are looking to pick up properties. Obviously, 8,500 sales versus 7,700 last year. There's more activity. The prices aren't going down. There's more activity than there was last year by a lot. I think a lot of that has to do with interest rates normalizing. People are getting used to it. I think it has to do with population growth. There's just simply more people here than there was a year ago. And I think 49 days on market, while higher than last year, that's still a pretty manageable number. So if you're looking to flip properties, 49 days on market it's totally fine. What do you think, Wade?
Yeah, I think that if you look at the months of inventory, it is up a little bit. To your point, days on market is really in line with a normalized market back in 2019. Property values are up 4% on the average, flat on median sales. So nothing negative there, just not some of the appreciation we might have seen in the past. And I think the thing we've been saying for some time, if prices are not dropping pretty significantly in the rate environment we're in, that tells you how strong the market is. I mean, that's rubber meeting road. Uh, because in other parts of the country, that number may be coming down. And the fact that the overall sales are higher than both last year and June of 2019, that's a strong number, volume way up. So there's a mixed bag of data, but here's where I think from an investor perspective, what should you be doing as an investor? The flip market back in 2007, 2008, 2009, 2010 was not as robust. You had to buy really good deals and you had to have a better product and a lower price to sell flips quick. But the thing is, it's a buyer's market. You can do that. You can get really good deals in flips. So it doesn't mean you have to be out of the market. You just can't be betting on the come, thinking that homes are going to appreciate 2%, 3%, 4% by the time you sell it. That's a mistake. But if you buy at a very quality price, you can put out a better product at a lower price, and not lower price by a ton, just a shade lower. I think you're going to be able to sell homes quickly. But where the real opportunity lies is for fixed to rent investors. We're going to go over some data later on where fixed to rent investors are really being aggressive right now. Out of country investors are being very aggressive right now. Anybody who's looking to do buy and hold, this is the time. And the people that made tons of money were the people that don't panic in a buyer's market. They see it as an opportunity. Not as much of a huge opportunity in flips, but a huge opportunity in fixed to rent. People were scared to death to do flips back in 09, 10, 11, 12. The people who bought fixed to rents absolutely printed money and did incredibly well.
Yep. Yep. I just look at the difference if I'm an investor looking to pick up some rental properties. Just look at the home sales and the active listings. In 19, you had roughly 8,100 sales to 30,000 listings, 24, 7,700 sales to 30,000 listings, 25, 8,600 sales, but to almost 39,000 listings. So your sales are up a little, but your listings are up a lot. So that tells me if I'm looking to buy rental properties, there's a lot more sellers that may be motivated. And we're going to get to some slides later, but I think there's just a lot more opportunities for buyers out there to pick up a lot of properties.
Yeah, so I guess just to recap right before we move on, looking at the long-term appreciation data, average sales price up 40% pre-COVID, 38% median, and relatively flat year over year. So let's see where we're at on Dallas on the next slide. So Dallas, comparable year over year data, to be honest, average up 3%. Houston was up 4%, down slightly on the median sales price. Houston was flat. Still, the average and median over pre-COVID numbers, a much more compelling and attractive story, up 58% on the average, 48% on the median. And you look at the days on market. Days on market is up to 52 days. That's a bigger number than Houston, but the months of inventory is not as large, although it is up a good bit over June 2019 to June 2024. Those rent rates being up 40% from pre-COVID, that's a very attractive number. And keep in mind one thing, if you think about this, it looks like it's gone up 1895 to 2600, 40%. That's what is that? Let's say $750-ish, something like that. That sounds like a big number, right? And it is, but the real difference, you don't have to look at the difference of, because if you were making $200 cash flow before all this happened, now you're making, all things being equal, you're making $950. Now that's not the reality. We know taxes are up, insurance is up, mortgage rates may be up if you had to take out a mortgage after that, probably didn't. But that is just a very, very attractive story on your cash flow going through the roof. So, whenever you look at 700 relative to 1895 does not sound as attractive, but being up 950 from 200, that is massive growth on your positive cash flow. And that's the number you really need to look at.
Yep. Like you said, it's a pretty compelling story. If you look at it, median sales price 277. So 6 years ago, you buy a house for 277, you're renting 1900. Maybe you're making $100 back. Back then you were probably cash flowing pretty well. But let's just pretend it's today and you're cash flowing nothing, right? Or it's a very little amount of cash flow. 6 years later, your house is worth 410. It's gone up almost 50%. You probably haven't paid a dime of that if you're doing a good job of keeping your property occupied, and you're able to raise your rents $700 minus an increase in taxes, insurance. Let's be fair. So maybe your cash flow it's not 700 if it was zero. It's probably closer to 4 or 5. It's hard to screw that up, to be honest with you. The only thing I will say is, look, the days on market on the lease, keep 35, 36 days. If you try and get cute with your leases and you put them out there for too much, you're going to be on the higher side of that number. You're going to be bringing the average up. And so while if you're making $200 a month cash flow, all it takes is 1 month to be out of the money, basically, and you eat up your year. So really be mindful of your rents. You don't have to rent it for the biggest number. You want to rent it for something that's going to be fair and that's going to rent quickly, so you don't have to worry about vacancies.
Yeah. To your point, getting fixated on $25-$50 whenever you're going to lose out on 2,600 for an entire month, that's not wise. So definitely price it to sell, be aggressive. If you haven't leased it in 10 days, be aggressive on a price reduction, because to your point, vacancy hurts more than losing 25, 50, even $75 a month, over time.
Yep.
All right. San Antonio.
I mean, I think it's a little bit of a comeback kid. I was looking at the numbers. So home sales are 3,000 sales. Listings are 16.6. But the average price, while Houston and Dallas, Houston was, they're both up 4%. But the median,
they weren't up on the median, right? They were either flat or down.
The median. So that tells me the lower priced houses in San Antonio are doing a little better, right? So because average prices, it's bigger because it includes a lot of deals that we frankly don't really care about, like your high end type of stuff. This is owner occupied properties as well. So that's going to be your more expensive properties. You have a much higher average median. So the median is a nice story for San Antonio. It's up 3%. Months of inventory of 5.3. I mean, not to bury the lead, but the months of inventory for every market, Dallas was as low as 4.7, and Austin's the high at 5.5. So the months of inventory for the entire state is somewhere between 4.5 and 5.5, depending on your market. Now, the days on market is longer. There's no way around that. 75 days relative to Houston, Dallas, which I think were in the high 40s and low 50s. So it does take a little bit longer to sell if you're looking to flip property. But that just tells me, one, if you are going to do a flip in San Antonio, that's fine. Just account for an extra month of holding costs, right? It's about your buy more than anything. And typically when I see deals come through San Antonio, I don't know about you, Wade, but usually they're a little bit cheaper. They're a little bit on the lower side when it comes to what you're paying relative to what your ARV is. So you can get those deals. I think that's probably priced in, but just make sure you say, okay, it's going to take me an extra 3 weeks to sell this property. So bake that number into your numbers when you're doing your profitability. But what it also tells me is if there's a lot of days on market, that tells me there might be some sellers that are getting nervous, because that it's two-sided, right? So if you're flipping, sure, account for some extra cost. But if you're a seller, then that tells me there's a possibility of being able to pick up some distressed assets, right? People that are maybe in a situation where they need to sell fast, or they can't wait any longer. So they're more likely to take a lower offer. So I do think, we've been talking about it for a really long time, but I do think San Antonio is a very strong market. When you look at the price of real estate, the income, the amenities of the market, everything is ripe for a good real estate and good rental market.
Yeah, I think we were showing some less than positive data on San Antonio for a while, maybe slightly down, but we kept seeing all these national articles and pundits saying San Antonio's one of the best markets in the entire country to invest in. And it's because of a combination of a couple things. Very low rents relative to income, right? Because income says what people can pay. And we'll look at it a little bit later. Candidly, the income in San Antonio is comparable to Houston, yet the rents are significantly lower. So there's upside there. In addition, the homes are a lot cheaper as well. So to your point, we're starting to see that now, getting some San Antonio momentum, which is really good.
Yep.
The other thing that I did want to say, and Jeff has mentioned this a couple times about being able to buy homes at a discount, and I do want the average investor out there to know that you aren't the one who has to do that, right? There are wholesalers out there doing that. If you got a full-time job, you're not the person who has to go out and negotiate with people. You're not the one who has to make lowball offers. You're not the one who has to be scouring the earth. Wholesalers are able to present better deals right now because of this dynamic. There are people out there doing this, and we are a conduit for that. We work with a lot of great wholesalers. We market these deals. We do deal nights. So when Jeff's saying that, I just want to kind of separate that. If you're thinking you have to be the one to do that, you don't. You just need to have contacts with people like us who can help you find those opportunities that are at a much better price than they were in the past because of these market trends that we're seeing.
Yeah, right. And if you're a professional with a regular job and you do this as a way to grow your wealth aside from your normal job, that's 100% correct. The wholesalers, the agents, they will do all this work for you and present the deals to you. So I just my wholesaler brain, I guess, was kicking in. So and we work with a lot of wholesalers that are able to provide a lot of deals to our borrowers. So it's San Antonio, it's a good time.
For sure. All right, let's check out Austin. So Austin, you see median sales price, and they don't provide average, unfortunately, but their median is flat, that's not unlike Houston or Dallas, a little bit below San Antonio. From pre-COVID, they're at 34%. But mind you, there was a time they were the hottest market in the entire country. They were up 55% in a 3-year period, and then they had a pullback, right? So, but I think that is stabilized there. The months of inventory is the closest to a stabilized market. Keep in mind, 6 months is a stabilized market. I know these numbers are above where they've been in the past, but they are not out of whack by any means. Six months is considered a stabilized market. That's been a long-term trend. And the days on market are not out of whack either. Like they're higher than they might have been in the past. And candidly, San Antonio and Austin had the longest days on market, but still nothing that's just, crazy. And, Austin, you just have to understand your market. Unless you're going to be doing duplexes or quadplexes, it's difficult because that average price point to find great rental properties within the major metro. But if you're doing duplexes or quadplexes, you can. Then you go single family, you just have to go farther out. Same thing in Dallas. You got to go farther out. You're not going to find a whole lot of stuff inside the major metro like you can in San Antonio or in Houston because the prices are lower. But I think Austin if you're buying right, it is a good time for flips there. And I know some people are doing them successfully. And we lend to all of these metros that we're covering. So we think it can be at the right price, a good market in which to flip properties. And to Jeff's point, bake in a little bit more time for holding costs, or in my opinion, I'd bake in less of a profit, like put a more attractive price and a better product out there. And I think you can shorten these 72, 75 day turn times way down because you're going to have to do multiple price reductions by the time you get to 72 days anyway. So just put it in up front, have less holding costs, put an excellent product out there below the rest of the market. And I think you can be half of this time if you do that, right?
Yep.
All right.
Yep, for sure. Months of inventory, 5.5. I mean, nobody really talks about Houston as being like slow or down. Houston's at 5.4. So I mean, it's very comparable. We're talking minor difference.
Yes, for sure. So this next slide I found interesting. Jeff, what do you think about it?
Yeah, I'll read it and then we can kind of talk about it. So it's official, seller's market no longer. There's some really interesting stats on there. Analysts agree nationwide shift from seller to buyer markets. This is from Redfin from, I guess, just this month. So analysts agree the nationwide market has tipped in favor of buyers. High inventory and interest rate stability are driving the change. Currently, there are 34% more sellers than buyers in the market right now. for the first time since 2013 that sellers outnumbered buyers by this margin. More room for price negotiation and seller concessions. So, that third bullet point right there is interesting to me. It has not been at this ratio since 2013. And that, if you guys remember, that's when we were kind of coming out of the GFC, I guess. It was still, I don't remember exactly, Wade. I know you were buying properties then, just getting started, I think. But was 2013 still considered a really good time to buy properties?
Good time.
Yeah,
for sure.
Yeah.
Yep, for sure.
So I think this is kind of what we were talking about earlier. The tide has changed, and it is turning into somebody who's a little more aggressive as a buyer. And there was another article I read previously that talked about really the widening, I guess, gap between renters and homeowners and their net worth. And so I think you're going to see a lot of this, where if you are an investor and if you can buy during these times, I think you're going to really pat yourself on the back 5-10 years from now, if you're able to pick up these properties. I think, like we're seeing it on our deals, the cash out of pocket is much lower than it was during the glory days, during the low rates. So it's just kind of progressing more towards that kind of market.
Yeah, I mean, just make sure people understand the glory day term there. There was a time when people were making $300 or $400 cash flow just because rates were absurdly low. But keep in mind that when they're already at the lowest possible rate, you can never improve that cash flow from a refinance. And the out of pocket was extremely high. So the ROI on those deals were worse back then. We see deals now, if you're willing to go outside of the major metros, where the ROI is infinity because the out of pocket is literally zero on deals, right? There are deals that we close every month where the out of pocket is zero and cash flows maybe less, 200, 150, 250. But the ROI is the number that sophisticated investors focus on, not just cash flow. If you're new to the game, you may hear about cash flow. That is a great number, but it's not very sophisticated because it doesn't bake in what you have to put in to get that cash flow. People back in the day were putting in 45, 50K to extract $350, $400 cash flow. Today, they're putting in zero to get 250. Like, that's a way better number by any possible measurement, because the number of properties you can buy is literally unlimited. Even if you only got 100K in the bank, if you're buying with zero out of pocket. So you didn't see zero out of pocket deals when rates were super low. They just did not happen. Never saw, right? It's possible. So
if you're investing back then and you see deals now, if you can get over the fact that your cash flow is lower, you're ecstatic because you're paying 30, 40, sometimes 50 grand for these deals. Now it's way less.
Yeah.
Now I do want to caution folks that are new. Just because a deal isn't zero out of pocket doesn't mean it's not an outstanding deal. There are still tons of deals where people are paying 20, 30 grand out of pocket, but there's cash flow, there's equity capture, there's a whole lot of things to look into it. So I don't want
also the markets. The markets, like I said, you have to go. You're not going to get that in Houston, Dallas, San Antonio, or Austin. Like, that's zero chance. You're going to really go to other markets and do that. So
I want to right set some expectations. If you're new to the game, don't expect it. I get a zero out of pocket deal. That's not always the way it is.
For sure. Yeah,
those are rare, but like to Wade's point, you got to go out far.
Yeah, and to back that up, in those markets, you're not going to have the appreciation that you're going to have in a market where you pay more out of pocket. But you have to bake that into, a great major metro where there's huge population influx, like Houston, San Antonio, Dallas. You're just going to have a lot more price appreciation over time. So that's another one of the big things to consider in real estate. All right, so next slide. 14.9% of home sales fell through, up from 13.9% in June. I can tell you this just did not happen very much in a lower rate environment. But, a seller, whenever they go to sell, they have a reason to do it. In this environment, you're not giving up your rate unless you have a motivation. You're moving. You had 2 extra kids and you have to get out of your house because you don't have enough space. Like, there's a compelling reason for people to give up their 3% rate if they're listing it for sale. Got a new job somewhere, you just have to move, whatever the case may be. Whenever deals fall out like this, that makes it even better for wholesalers because they come in and provide a service. And so all this data, while it looks scary from one perspective, it is really very exciting news if you're a real estate investor looking to pick up attractive deals. So this is all good data because we're really looking to buy properties at a discount in a buyer's market, right?
All right, so I'll read this one and we can talk about it. So this is Texas specific. So Texas market cools, investors staying active, while market rebalances, investors taking advantage. So Texas housing prices have plateaued with rising inventory levels in mid 2025. With this increased inventory, homes requiring repairs or cosmetic updates are struggling to sell. Buyers are now less willing to overlook these issues. Obviously, we're talking about end buyers here. If we're talking about investors, that's a glorious thing, right? Investors and cash buyers still actively purchasing homes, filling in the market gaps for these types of properties. Sellers who are unsuccessful listing on the open market are now looking to quicker and simpler ways forward, opting to sell properties to off-market buyers. So if you're a real estate investor looking to pick up deals, this should be music to your ears, right? You want these sellers, I mean, not to sound cold-hearted, but you want these sellers in a situation where maybe you are the solution, right?
Yes.
The property, think of it that way. You're not trying to take advantage. You're solving their problem, right? So if they can't sell their property because there's repairs that they maybe can't afford to fix, whatever the case may be, it's been sitting for a while. They are way more likely to consider off-market deals. So, the wholesalers there's wholesalers on here or dealing wholesalers, that should be an alarm bell saying, hey, let's get active, because if this is happening on a national level, they're usually a little slow to report. With boots on the ground is probably, it's probably more widespread than you would even think on this article.
Yeah. I like this next slide maybe the most. I think we have a lot to talk about here. This is Wall Street Journal article from last month. Nationwide investors swooping to market. Small and local investors outperform larger firms. So far in 2025, investors who buy homes for buy and hold or flips made up 30% of the purchases in single family properties, highest on record in 14 years. Oddly enough, 14 years is right around 2011, which is the last time that we felt like there was a true buyer's market and people were really, really doing well. And if you remember back at that time frame, the people did, like, the long-term appreciation from that point has been absolutely stunning, because you had a pretty good dip in house prices in that 08 to 10, 11 range. And then people just made a lot of money there. So smart people are in the market now. You don't want to buy when everything's rainbows and lollipops. You want to buy when there's, some challenges in the market, which there are today because of interest rates. And the group has shifted from large firms and private equity, who a lot of them got burnt. I don't know if, I'm sure you remember this too, Jeff, like the Zillows of the world, the iBuyers, they were buying crazy next door or something like this, just ridiculous offers. And a lot of them really, really were burned, because sometimes these private equity groups, they only have, a certain amount of time to spend money. So they're just buying irregardless to meet that number, because they're making let's say a 2 and 20 type arrangement, or whatever the case may be, where they're making money on just basically buying the properties and spending people's money, whether or not they actually make a profit. So they're highly motivated to put deals to work. Whereas local investors look at it differently. So they have spent a lot of their money, burned their investors, and it's moving back to a localized market with a lot more local investors, which is a win-win for everybody, because local investors don't make stupid decisions like some of these guys were. I mean, they're supposed to be the smart money, but they were so motivated to buy, betting on the come, that it just didn't work out. So that shift to smaller investors is very good for everybody on this call. I'm assuming BlackRock's not on this call listening to Jeff and I today. I assume it's a mom and pop investor who is looking to get information on how they can succeed. So this is nothing but good information there. Another thing that they said here that I thought was interesting is that even with prices and interest rates higher, they still see a solid opportunity in this category of renting out homes. Like, that is the key, I think, more than anything. If you're looking to rent properties, You can even be a little bit more aggressive on your price because you know what will come down the road, the opportunity to refi and home price appreciation. If you're looking to flip, you have to buy a little deeper, but that's good too. Because if you look aggressively enough, you can find those flip opportunities from wholesalers as well.
Yeah. I didn't, it's funny because I was going to ask you, like, I remembered as you were talking, I don't remember what the name of the group was. We were working with a group that they were basically paying almost retail for these properties that needed a lot of work. Like they
Yeah.
were just bidding them up, which makes sense, right? If you think about it, they were doing it when rates were low. That's when, if you were one of these small single family investors, like most of us are on this call, like you were struggling to find deals probably because there was so much competition from private equity firms just paying stupid numbers. So the fact that they've seemingly dropped out of that is a great thing for investors, like you said.
There's
But I
still some
totally
that are active, but they're a lot more prudent. Like
yeah.
back in this time we're talking about, 2021,
20,
2022.
yeah.
It was wacky. It was just wacky what they were paying.
Next slide. So this is a little bit different, but it's the same concept. So foreign buyers' influence on U.S. housing, an uptick in foreign investment activity in 2025. So according to July 2025 report, this is from Investopedia, from NAR, the foreign purchase of U.S. homes rose 44% year over year, from 54 to 78. While increasing, this is still a considerable drop from 2017, when investors purchased 284,000 properties. So it is a lot less. International buyers create upward pressure on housing prices and rents, especially as foreign buyers pay in cash 47% of the time compared with just 28% for domestic buyers. Foreign investment in U.S. real estate tells a story of global wealth-seeking American stability, but it's also reshaping local housing markets. So it looks like, I guess, 8 years ago, I don't know if this was the peak, but I'm guessing it was close because they put that number out there, 285. But it seems like foreigners are starting to jump back into the U.S. real estate market, which will drive prices up for sure. But anyway, I thought this was a pretty interesting article.
It's not driving prices up right now. I think they're filling a void, right? They're filling a void of the home buyers buying this inventory, which is what local investors are doing, but these people are doing as well. The thing that's interesting is that they're using cash 47% of the time. I'm very confident they were not doing that in 2017 because rates were significantly lower. So if you think about it, foreign wealthy individuals or institutions see this as a very good time to buy, even with cash, because of the upward mobility or upward appreciation that they foresee, as well as a good time to get quality rents. So anytime you see that, I think it's still a very positive story for the buy and hold investor. If you're able to make cash type offers as you are, just a little pro tip, whenever you use a hard money lender, almost all investors I know are going to communicate a cash offer, which really differentiates you from the competition. Little pro tip: if you're buying from a sophisticated investor, such as a bank REO or something like that, they are not going to be comfortable with that. They're going to, because the deed is different. A cash deed is different than a finance deed. But for the average seller, that never comes up. And hard money lenders, if you deal with reputable ones, you're always able to make your closing. So it is a pro move to communicate that cash offer, so you're competing against these other people rather than saying a financed offer. Now, if you're working with a very good mentor, like we talked about earlier, Total Wealth Academy or something like that, they're going to help walk you through that cash offer capability. But that is something that you always want to be thinking about. How do I differentiate my offer if I'm making it myself? And that's a really good way to do it.
All being in business, I think one deal has fallen out because the seller got upset about a cash offer. One in like 11 years we've been doing this, so it's a great point.
Yep.
Okay, Wade, this one's yours.
Texas continues to lead U.S. migration. So we always talk about the market, the real estate market, like many other markets, is very, very separated, bifurcated, whatever word you want to use. So it's very different in Texas than it is in New York, than it is in California, than it is in Florida. And you really want to understand your local market and what is influencing the numbers, the data, right? So once again, Texas is the top U.S. state for both domestic and international migration, adding 562,941 people. And this, people talk a lot about this triangle of enormous population. It's growing faster than any other area in history, as I understand it, with Dallas, Houston, San Antonio, and Austin. Just crazy. The growth is incredible, and there's a lot of things driving it, right? And you, as an investor, get to live in an area. If you're on this call locally, some people are in Hawaii. We have Hawaii, California, New York investors too, but a lot of you are local, and you get to live in an area and touch and feel some of your investments. And you're in arguably the fastest growing area, and with very low home prices and excellent rents. Like, it's a perfect storm for real estate investors to take advantage of. That number is huge. And then also, why would it continue to grow, right? No state income tax, lower housing costs, and less regulation. That's why so many big companies are moving. I'm sure you've seen over time how many companies have moved here. I actually pulled up some information to just run through a couple of big names that have moved to the area from other places, like X and SpaceX have moved to the area. Yum Brands, or KFC, their headquarters moved to Texas. Chevron went from California to Houston. John Paul Mitchell Systems to the Dallas area. Major League Cricket moved here. Like, just a lot of really big. I think they're building the biggest chip plant in the United States outside of Austin. So you have this confluence of factors that say home prices are going to go up because they're bringing high quality, high paying jobs to the area, and the population is continuing to grow. So I think there's a lot of good reasons, and we want to keep talking about this migration data because it is a reason to predict higher prices going forward. When you're a real estate investor, you don't just get one thing. If you think about it, if I own a stock, unless it pays dividends, which is rare, I make money from one thing, stock price going up, and I have to sell it in order to make any money, right? You don't get tax deductions. Conversely, with real estate, you can put it in an LLC or in your personal name, and you get tax deductions for the money that you spend towards that. That's a golden thing. You can also write it off towards your W-2 if you structure it properly, which is incredible. You get home price appreciation just like a stock would, but then you get cash flow every month, right? That's another compelling difference. And there's just so many things that come along with that that's different in this category. So whenever you're looking at the reasons that we predict home prices to appreciate, there's certainly a lot.
Next slide. So this is kind of talking about Texas and what Wade was hitting on. So Texas sets new record high job count in May, 6 months in a row for new record growth. Wow. Texas continues to be a top state for growth and business success, with 28,000 jobs added in May. New record high was set for Texas with a total of 15.8 million workers in the civilian labor force. That's a lot. Mm-hmm. I don't know. I'm always curious what the civilian versus like public sector, but trade, transportation, and utilities industry had largest over month increase, adding 8,400 jobs. And then construction industry grew by 3.4%, outperforming the national growth rate by 1.9. So, I mean, it's just all good things. I mean, I would much rather be on this side of it than the other side where jobs are leaving, right? So it's just the fundamentals of a good economy. You have a good environment for business. Companies will come. They need to hire folks. People will come. I mean, I consider myself lucky to be living here, to be honest, because there's plenty of folks that are in the exact opposite situation, maybe in other states, based on a lot of different factors. But it's a great time to be in Texas.
For sure. All right, the next slide. So David did a great job putting this together. I thought this was the data is just so compelling, yep. Right? People would love to own a home. They'd love to have a good, compelling reason to buy a home, but the main reason they can't do it, like back in the day in 2013, there are a lot of other reasons why people did not buy and they chose to rent. But today, 68%, up from 45% when rates were lower back 12 years ago, 68% just simply cannot afford it. So people still need to have a home, right? And most of them a lot of them, I don't want to say most, a lot of them want to have a yard and they want to have their own property, but they really can't afford to buy at the moment. So that's where the single family investors or the single family 1 to 4 investors with a quadplex or a duplex really feel a void because there's yard and it's a smaller environment. Some people are comfortable living in an apartment. Some people want something different. But this data is very compelling. So at a time when you're able to be in a buyer's market because of this factor, these people still, many of them want to have a home, and that's where you fill the void, providing a good, high quality property to live in. But all of these other numbers are way down. In fact, the average FICO score is way up right now. People are in a better financial situation in a lot of ways than they've been in the past, but it's just interest rates are so high. It's hard to buy a car. Interest rates are so high. It's hard to buy a house. And even though people they're seeing even some income gains, especially in the private sector. I heard a lot about, there's a lot of private sector average income gains. There's not as much in the public sector because there's been some cutbacks there. But, so there's a lot of compelling things that say people are going to be ready to buy as soon as rates come down, which we're going to talk about rates in a little bit. But I thought that this was very, very interesting how much of an increase there's been and just can't afford to buy from 12 years ago. Jeff, are you frozen there? I don't know. Jeff may be frozen. I'm going to go ahead and start on this slide because I can't see him. I don't know if he's having some technical difficulties.
I froze or Wade froze? Was that me?
I don't know. If you're free, just go ahead and chat. I can hear you now.
All right, good. There we go. Okay. So a little on a lighter slide, cute little puppy. Pet-friendly rentals perform better. This is actually pretty good advice if you're a landlord. So a new analysis of more than 11 million rental listings last year showed that pet-friendly rentals drew more views, saves, and shares and released 8 days faster on average. I mean, that's compelling. Renters are getting older and are more likely to have pets. Now nearly 6 in 10 renters have a pet, up from 46% before the pandemic. Texas has a claim as the most pet-friendly state, with Austin at 80%, Dallas 79%, San Antonio 78%, leading all metro areas in share of pet-friendly rental listings last year. I mean, it makes sense. I don't know how much more damage a pet can do, I suppose, but if you're looking to rent it fast, nationally, 8 days, that's not insignificant. Plus, I think just younger folks aren't having kids, but they do have a lot more pets. So if you're going to rent to, a younger person that maybe, because I read an article about first-time home buyers and how there really aren't. That stat is down. So a lot of younger folks are the ones that are filling this void, and birth rates are down, so they don't have a lot of kids, but they do have a lot of pets. So I do think it makes sense to be a little more pet-friendly with your leases.
For sure. This next slide is interesting. Like we talked about this, and in an environment where rates are very low, you're gonna have more vacancy because everybody can buy a house. We're seeing that vacancy rate, go up a little over time, but still, if you look at the vacancy rates, in other higher interest rate environments, we're not to where we were in the 70s and 80s where rates were outrageous and nobody could afford to buy a home. I mean, it's still feasible at the moment, just not quite as attractive. So this rental vacancy rate, I think, will continue to play in our favor in a higher rate environment, right? Still historically lower than it definitely was from 80 something to 2015 or something like that, for sure. Way low. All right, next slide.
So this is interest rates.
Yep.
Yeah, like what you're saying, historical interest rates. We kind of show this always to give, if you're new to this, we give this, we do this to show a little perspective. What are we doing there? 6.72. I guess that's today. Okay. So it's 6.72. Obviously, if you look from roughly maybe 2009, 10, obviously those were a much lower rate environment. And I'm going to argue that was probably more of the outlier then there's no argument. That was more of the outlier than what we're in today. Like today is more of a normalized interest rate, historically speaking. Obviously, the early 80s was an outlier, just like the last, say, 5 or 6 years was an outlier, starting back in 2022. The one thing that I wanted to talk about is I was reading an article from an economist talking about, okay, well, at what rate will that kind of open up, like that chart we showed earlier with people not being able to afford a home? What rate will kind of trigger a reversal in that? And basically the consensus was below 6%.
Yeah,
So if they
not
get
far
below
away.
6%, yeah, no, not at all. So if they get below 6%, it's going to trigger a lot more buyers. So if you're a flipper, right, that if that happens, great, you'll have more options. Um, if you're a buy and hold person, that tells me get after it now, because you're going to have, if and when rates drop, you're going to have more people looking to buy houses as opposed to rent. So I would get into it now to get those properties while they're still pretty low out of pocket, and take advantage while you can.
Yeah, a couple things on interest rates I did want to chat about. There's quite a bit of data that says that it might be an appropriate time to lower, but it has not happened yet. But it was the first time since 1993 that two Fed governors dissented from the vote.
Saw that.
So I do think that there's some momentum for reductions. It was very interesting because in the past, when the jobs report was a little bit slower and the inflation was low, they would normally maybe take a reduction there. So it is an interesting time, but I don't know exactly what's going to happen, but there are several Fed governors who are dissenting from this keep interest rates steady environment. So still hoping for some reductions later in the year, which would be a big deal. But secondarily, keep one thing in mind. The Fed does not have to lower interest rates for mortgage rates to come down. The spread is very high right now. That's built upon the perceived value of the bonds that we're putting out, mortgage bonds. So there's still an opportunity for rates to come down despite the Fed not lowering rates. So if the economy is strong and there's a perceived better fiscal responsibility out there, there's still some opportunity for that to come down as well. So there's two different ways interest rates could come down is the bottom line from what I'm trying to say.
Yeah.
All right.
Last slide.
Yeah, this affordability index, we always cover it. And if you're considering San Antonio, I always love this story. I'm gonna go to San Antonio first. If you look at that, San Antonio is number 55 55th most affordable, or least affordable city, I guess you would say, because Los Angeles is number one, least affordable. They do a good job of staying number one in every time slot here. And then it dropped. San Antonio dropped to 70, and now it's 69. So over time, over these last couple of years, San Antonio has become increasingly more affordable, right? And one thing that's really interesting is you look at July 2025, Houston, number 32, on average household income, 65 grand, right? San Antonio, also 65 grand. I mean, the number's almost identical. But
Yep.
the average home price in Houston is 369. The average home price in San Antonio is 279, a whopping 90K less, as a percentage, significantly less. So I see nothing but upside there based on what the average person makes. The rent rate also is significantly lower there. So real opportunity for appreciation and for rent rate increases in San Antonio. That's something we talk about almost every one of these, but I just see lots of upward mobility there on price and rents. Anything else jumping out at you, Jeff?
Well, no, like you said, we talk a lot about San Antonio, Austin, and Dallas. They kind of jockey back and forth. And Houston's usually a distant third between, although 19 they weren't. But yeah, no, San Antonio is the one that really jumps out at you because it's a major city. A lot of people are starting to go outside of San Antonio as well to find some really good rental properties. But yeah, it's so much cheaper, and the income is the same as Houston. So it is, again, earlier, like, it's nice to show, the the benefit of living in Texas, where you have a lot of these houses, a lot of these prices are very affordable relative to the income. And I'm just thankful I don't live in LA or Irvine, where all of my income, I mean, obviously there's tons of renters there is what that is, but because nobody can afford 99% of their income to go towards their house. But it just shows how fortunate we are down here in Texas.
Yeah, for sure. And this is only house price. It doesn't bake in higher
Right.
state income tax, higher, everything else, right? This is just mortgage payment. This doesn't include higher insurance rates, higher other things. So, yeah, it's really, really got to be tough. And that's why so many people are moving to the area. Last thing I will mention is that Houston, if you think about it, it's pretty, population and amenities, a lot of, while it may not be, some people may not see as beautiful, and I might agree with that as some other top 5 cities, but when you look at great restaurants, sports teams, all kinds of fun things to do, to say it's 32nd is a pretty incredible number there as well. And Dallas, same thing, a little bit more of a white collar town, but really incredibly attractively priced considering the amenities versus, the Miamis, New Yorks, Irvines of the world. So lots of upside even in those cities outside of San Antonio. All right, we got a few minutes. What's that?
I was just saying, if you look at Dallas, well, Dallas proper is pretty high on the list. All those suburbs are much lower. So once you get outside of Dallas, it is a lot more affordable.
For sure. So I think we might have a couple of questions to wrap up with, David. Is that right? And we always do a drawing, so we got a winner.
Yeah, absolutely. So, excuse me. So our winner is going to be Ann Rogers. That is on the call. So congratulations, Ann.
Nice.
And then we did have a couple questions that came in. One of the ones that I've got here is a house I found has flooded before, and the insurance is super high. Is there a cheaper way to get flood insurance for rentals?
That's a good question. So there's a couple different ways to do that. You always want to check both policy types. There's normally there's going to be like an NFIP policy, which is kind of a federally subsidized policy. Then there are going to be private policies. So you want to cast a wide net and check both of those at all times. Secondarily, there often is an opportunity to get what's called an elevation cert. It's done in concert with a surveyor. And if you do that, you can often get a reduced price because the property may have been built up outside of the floodplain. The standard flood insurance, if you don't have an elevation certificate, is just going to be based on the geographic area, not based on the actual height at which the property was built. So that's another pro tip. And, if somebody's selling a property, they may not be as sophisticated as you and it's in a flood zone and they've not pulled an elevation certificate, that's something you might be able to do. You see, you can get an elevation certificate that's going to make that number more attractive and then really save a ton of money on flood insurance. Another thing I hear from most real estate investors in the current environment, especially people that live anywhere near the coast or their properties or anywhere near the coast, you can often get flood insurance incredibly inexpensive. And if it's not in a flood zone, I would encourage that. Sometimes it's only $25 a month or in that range. And that is a really smart move because there's often going to be some cataclysmic event you can't really predict, like a Harvey or something like that. And if you're a real estate investor, you do not qualify for things like FEMA protection. Or if you're a homeowner, even if you don't have flood insurance, you can get some money. It's not an enormous amount of money, but it can definitely help. If you're a real estate investor, a non-owner occupied homeowner, you're not eligible for that. So if you can get very inexpensive flood insurance and you're somewhere in Houston or something like that, it can be a smart move. If you're obviously in the hill country and somewhat close to a river or a creek, that could be a smart move. Other parts, if you're not close to anything like that and in the hill country, probably not wise because it's very dry. But if you're near the coast, that can be a very pro move.
Alrighty.
And that's David, or is that it?
I got one other one, and it's kind of a two-part question. So they said, as investors, which Texas city would you be buying a house or property in right now? And then the second part to that is, should I wait for rates to come down before buying?
Well,
I lost you, David.
I think I can answer the second one first. You should definitely not wait for rates to drop to buy. For all the reasons we were discussing Rate drops typically means an increase in buyers, which means an increase in competition, which means more money out of pocket for your deals. So I would much rather buy properties now with significantly less money out of pocket. Like Wade said earlier, you can't change what you pay for the property, but you can always refinance. You can always raise rents. I would much rather deal with very low out of pocket and maybe very little cash flow to start, as opposed to this big giant chunk of money I put in and I'm chasing and praying that I can make up for it later. So I would highly recommend people don't wait for rates. A, you never know what they're going to do, but B, I mean, you may be on the sideline for another 5 years, who knows? But there's just less competition with the higher rate environment. And then the other one was about like where to buy. I personally, I think a deal is a deal is a deal. If you can get a good deal anywhere, I wouldn't recommend one over any of the others. I don't wait if you have an opinion on the matter, but I would buy wherever a deal is a deal. To be honest with you.
Yeah, I mean, I like I said earlier, if you're in a major metro, you're going to have more appreciation. That's a reality of it than you're going to have in Port Lavaca or Port Arthur or some other place where you don't have the amenities and the job opportunities and stuff like that. So you just bake that in to just point like, hey, you're going to get lower out of pocket somewhere like that, but you're not going to have as much appreciation. That's kind of baked into the market. But if you get a really good deal in either one of those areas, there's just going to be different pros, right? Different cons, but you're still doing an evaluation. I think you can try and invest close to home if you can, get some diversification outside of your market. And if you're in a state where you can't invest in that market, then you go to other markets. You invest where you want to invest and live where you want to live. If you build out the right team, you can literally invest anywhere. We do deals with people from Hawaii, California, New York, all over the place, right here in Texas. And if you have the right infrastructure and team, you can do that very well. All right. Is that a wrap, David?
That is, I do have someone, and we'll reach out in kind of talking about how to explore flood insurance reductions, kind of thing. I don't know, Wade, you might want to say just, what would you go about? What would be the process to, look into getting an elevation certificate?
Just order it from a surveyor. You order a survey and an elevation certificate. It's done by a surveyor. Pretty simple. Just and also there's some great information on like Google or Chat GTP on not only the process but also how to order it from a survey. It really depends on the market you're in. I can't recommend anybody, but it's not a very difficult process. It's very common. You send over that elevation search to the insurers and they
call your
adjust
insurance
it.
company.
Yeah.
Yeah, call your insurance company.
Yep.
Absolutely. Awesome. That is all our questions, guys. Thank you very much.
Thank you. Thank you, David. Thanks, everybody.
Thanks, everybody. Have a good one.